What is investing? Well, investing is essentially about growing your money over time. It's a way to make your money work for you, rather than just sitting in a bank account or being spent on everyday items. You use your money to buy something that you think will increase in value. This could be a business, real estate, or even a piece of art. Each type of investment has its own risks and rewards, and it's important to understand these before you commit your money. Unlike spending, which is using money for things you need or want right now, investing is about planning for the future. It's about setting aside money today with the hope that it will grow and provide financial security down the road. When you invest, you're aiming for long-term growth, which usually means a period of several years or even decades. This long-term perspective is crucial because it allows your investments to recover from short-term market fluctuations and benefit from the power of compounding. Investing requires patience. It's not about getting rich quick, it's about making smart choices with your money. Patience allows you to ride out the ups and downs of the market and stay focused on your long-term goals. Successful investing means watching your money grow over time. This growth can come from the appreciation of the assets you own, dividends from stocks, or interest from bonds. Investing is essential for building wealth and achieving financial freedom. By diversifying your investments, you can spread risk and increase the potential for returns. It allows your money to work for you. Instead of sitting idle, your money can generate more money. This is the essence of passive income, where your investments earn money without requiring constant effort from you. By investing wisely, you can achieve your financial goals and secure your future. Whether it's buying a home, funding your children's education, or enjoying a comfortable retirement, investing can help you get there. Remember, investing is a journey, not a race. It's about making informed decisions, staying patient, and keeping your long-term goals in mind. With the right approach, investing can be a powerful tool for building a secure and prosperous future. Now let's talk about investing versus saving. What's the difference? Saving and investing are both important, but they serve different purposes. Saving is setting money aside for short-term goals. This could be an emergency fund, a down payment on a house, or a vacation. Savings accounts offer security and easy access to your money. On the other hand, investing focuses on long-term growth. You invest money for retirement, your children's education, or other long-term goals. Investments have the potential for higher returns compared to savings accounts. However, investments also come with higher risks. Saving is about preserving your money. Investing is about growing your money. Saving is good for short-term needs. Investing is better for long-term goals. Both saving and investing are crucial for a healthy financial life. Diving into stocks means owning a piece of a company. Stocks are like small pieces of a company. When you buy a stock, you become a part owner of that company. This ownership is called equity. Stock prices go up and down based on the company's performance and other market factors. Investing in stocks can be profitable. If the company does well, the value of your stocks can increase. You can then sell your stocks for a profit, which is called capital appreciation. Some stocks also pay dividends, which are a portion of the company's profits that are distributed to shareholders. However, investing in stocks carries risks. The stock market can be volatile. Stock prices can fluctuate, which means you could lose money if you sell your stocks at a lower price than you bought them. It's important to research and choose stocks carefully. Let's explore the power of bonds, lending money and earning interest. Bonds are different from stocks. When you buy a bond, you are essentially lending money to a company or to the government. In return, the borrower promises to pay you back the principal amount and also pay you regular interest payments for the use of your money. Bonds are generally considered less risky than stocks. They offer a fixed income stream, which makes them attractive to investors seeking stability and predictable returns. Bonds are a good addition to a diversified investment portfolio. However, bonds are not risk-free. Interest rates can affect bond prices. When interest rates rise, bond prices tend to fall. Conversely, when interest rates fall, bond prices tend to rise. It's essential to understand how interest rates impact bond investments. Section 5. Mutual funds and ETFs. Investing in baskets of assets. Mutual funds and exchange-traded funds, or ETFs, are like baskets of investments. They pool money from many investors and use this money to buy a diversified portfolio of assets. These assets can include stocks, bonds, or other investments. Mutual funds and ETFs offer instant diversification. Instead of buying individual stocks or bonds, you can invest in a fund that holds hundreds or even thousands of securities. Diversification helps to reduce risk by spreading your investments across different asset classes. Mutual funds and ETFs are managed by professional fund managers. These managers make investment decisions on behalf of the fund's investors and aim to achieve the fund's investment objectives. Mutual funds and ETFs are readily accessible to investors through brokerage accounts. Section 6. Real estate investing in land and property. Real estate involves buying, holding, and selling land or buildings for profit. It's a tangible asset that has historically been a popular investment choice. Real estate can provide rental income, capital appreciation, and tax advantages. Rental income is the money you earn from renting out your property. Capital appreciation refers to the increase in the value of your property over time. Real estate investments can also offer tax benefits, such as deductions for mortgage interest and property taxes. However, real estate investments require substantial capital. Property prices can fluctuate, and real estate markets can be cyclical. Investing in real estate also involves ongoing expenses, such as property taxes, insurance, and maintenance costs. Section 7. Balancing risk and return. A key to successful investing. Risk and return are fundamental concepts in investing. Risk refers to the possibility of losing some or all of your investment. Return, on the other hand, is the profit you expect to earn from your investment. Generally, higher risk investments have the potential for higher returns. Conversely, lower risk investments tend to offer lower returns. It's crucial to find the right balance between risk and return based on your financial goals, time horizon, and risk tolerance. Understanding your risk tolerance is essential. Risk tolerance is the amount of risk you're comfortable taking with your investments. If you're risk-averse, you might prefer lower-risk investments. If you're comfortable with risk, you may consider higher-risk investments. Section 8. Diversification. Don't put all your eggs in one basket. Diversification is a key principle in investing. It means spreading your money across different asset classes. This minimizes risk. If one investment performs poorly, the others can cushion the impact. Diversification reduces the impact of market volatility. By investing in assets with different risk and return characteristics, you create a more balanced portfolio. A well-diversified portfolio should include a mix of stocks, bonds, and other asset classes. The specific allocation to each asset class depends on your individual circumstances. Younger investors with a longer time horizon may choose to allocate a larger portion of their portfolio to stocks. Older investors closer to retirement may prefer a more conservative approach with a higher allocation to bonds. Section 9. Getting started. Your first steps into the world of investing. Investing may seem complicated, but getting started is easier than you think. The first step is to set clear financial goals. Determine what you're investing for. Is it retirement? A down payment on a house? Once you know your goals, you can create a plan to achieve them. Next, you need to determine your risk tolerance. How much risk are you comfortable taking with your investments? Your risk tolerance will influence your investment choices. Consider your financial situation, time horizon, and investment knowledge. Open a brokerage account. A brokerage account is a type of account that allows you to buy and sell investments. There are many different brokerage firms to choose from. Research and compare fees, features, and customer support before making a decision. Section 10. Patience and information. Your allies in the investing journey. Investing is a long-term game. Patience is essential for success. Don't expect to get rich quick. Focus on making informed investment decisions and sticking to your plan. Avoid making impulsive decisions based on short-term market fluctuations. Stay informed about your investments. Keep up with market trends and news that may affect your portfolio. Read books, articles, and financial websites. The more knowledge you have, the better equipped you'll be to make sound investment decisions. Remember that investing involves risk. There are no guarantees in the stock market. It's possible to lose money, especially in the short term. However, over the long term, investing has proven to be a reliable way to build wealth. Stay patient, stay informed, and watch your money grow.